All right, real estate investor case study time. So over the next several videos, we're going to look at a number of case studies that models funding a cash value life insurance policy, but demonstrating how real estate investors actually use the policy to finance real estate. So let's get into case study number one here. We are going to take a look at a 35-year-old male funding a policy for a short period of time. 5 years. I love demonstrating short funding periods. The reason why is it could just be a thing of mine when I hear the word whole life insurance, or when I was first in the industry, it showed payments forever. And people would look at this and say, hey, I love the product, but like I'm kind of turned off by the idea of having to pay until I'm 100 years old. Like I'm not into that. So you don't have to do that by any means. You can fund for a short period of time. So we're going to look at funding a policy for 5 years only, and then looking at two policy loans, one in year 3 for $100,000, and then one in year 15 of $300,000. So what I'll add as a quick side note is we can take loans really anytime we want with a life insurance policy. Whatever we have in cash value is what we have access to, which is a nice feature. And we don't have to spread them out as far as we see here. Now, one other question we get too, or that you may have, because this comes up quite a bit, is, hey, if we're looking at a 5-year funding period, if that's what we demonstrate, does that mean that I have to stop payments after 5 years? No, not by any means. So what we've got up here is a quick example of the same policy, one funded for 5 years, and then the second assumes the individual continues to make payments and funds $50,000 per year for 30 years. And where we can demonstrate that it's the same, by year 5, stop the payments here, but cash value, $253, death benefit, 2.5, over here, 253 and 2.5. The difference, here I stopped, here I keep on going. I keep feeding the beast, call it. Case study 2 actually demonstrates the 30-year funding example. We wanted to show a lot of information, a lot of different examples, because this happens frequently. You know, someone buys a whole life insurance policy, they're really attracted to using the cash value, call it as a personal line of credit, getting money in there, letting it compounding and using it. But often what happens is we look at it and say, hey, this is compounding at a decent rate. I'm still cash flowing, so I can throw money in my bank account, or I can put it in here and have it continue to grow for me. All right, I'm gonna put it in here and continue to enhance real estate and everything else. But let's take a look at the examples here. 35-year-old, 5-year fund. Anytime we look at a loan, what I like to show is what does the policy look like if I just pay into it and let it sit and grow. That provides a direct comparison to see the impact of policy loans. So if I'm using this to acquire real estate, right, because the real estate's going to cash flow for me ultimately, I still want to understand the mechanics on the policy. This way I don't do something and find out after the fact, oh man, I should have done something else. Like what happened? All right, so here's our growth scenario. Just 50 for 5 years. And what I want you to take note of to start is policy year 3. 141, 208, 2.17 in death benefit. Here's why. In the loan scenario, now this is going to demonstrate interest-only payments, and this is with a company that has a loan interest rate of 5%. You could go the collateral route, the cash value collateral, and get 3.25%, which would go direct to the lender. But here, $100,000 loan comes out, okay, borrowing directly from the policy. Before we look at any interest payments, any modeling, here's the question to ask. If you're a consumer, if you work with us already, if you're considering working with anyone, what is the impact of that policy loan on my policy, cash value and death benefit? Here's my cash value. Reduces by the $100,000 that I pull out. It's actually $105,000 because we make no payments in the first year we pull that policy loan out. But you see the reduction, whatever I pull from my cash value, that's the equity, call it, I see the reduction occur. Now, from what we covered in the overview video, the company is still going to pay dividends on the full 141. Another way to put it is I'm still going to receive a dividend on any money in cash value and any money outstanding in loans. There's no lost opportunity cost here. How the insurance company does that is, one, I have the loan interest expense, but really, if I take a loan from a bank, I typically have to put up what? Collateral. Here you go. Look at your death benefit here compared to over here. You pulled out 100. How much did it drop by? Exactly $100,000. Anytime I take a policy loan out, the insurance company is going to collateralize my death benefit dollar for dollar. Think of it this way. They're a life insurance company. What's their first and foremost obligation? To pay out life insurance claims. If I die with a loan outstanding, that's a lesser claim. Think of it that way. Now, paying interest only. So we should add additional columns to this, and we likely will in future case studies to demonstrate what is my true net out of pocket, because technically here I paid in $250, but then each year I'm paying another $5,000 in here on that 100K loan. Down here I take out another $200,000. Look at this. Now your loan balance is what? 300K. Cash value, death benefit. Compare that to over here. 403 in cash. Subtract 315 from that, and you'd come up with that 88. And then your death benefit. Is it a $300,000 reduction? Clean reduction. If you're an agent and you'd like to see how we modeled this in the actual software with the insurance company we used, our agent training program discloses that in full detail. And if you are an interested consumer or you work with us already and you'd like to see the detailed illustrations, that's in our membership program. So in this example, all we do is pay the loan interest forever. Think of it as an interest-only loan. Now the thing is, and I thought about doing this, but I didn't, you can stop the interest payments as well. Especially if I'm 30 years into it here, if I got $500,000 in cash value, 300K loan balance, the loan interest is not going to exceed the interest earned at this point in time. Depends what my cash value balance is. But here, we just assumed loan interest payments forever. And what you will find, let's go 50 years down the road. Here's where it gets interesting. Your loan balance is what? 300K. What's the difference in cash value and death benefit? About 300K. That's consistent. If you pay the loan interest, or I should state, whatever the loan balance is, you're going to see that delta there with the policy where I just let it sit and grow compared to one with a loan outstanding. Now, let's look at the repayment example, because this is really where it gets fun. So, same thing on the left. Growth. 50 for 5 years. Same thing year 3 when I take that policy loan out. There's the dollar for dollar reduction. Now, we paid the interest. This is interest out of pocket. And then also, this is the interest payment, I should say. We started throwing $20,000 at the principal balance each year. So, why this reads $25,000 in policy year 6? So I made 0 premium or PUA payments. What happened specifically here is I made the loan interest payment of $5K plus $20K towards the principal in this particular example. We can pay it back however we wanted. This is just how we ran this particular model. That's why at year 10, what you'll notice, look at the year prior. Your loan balance is $20,000. 5% of that $1,000, that's where the loan interest came from. That's why my full loan payoff at that point in time is $21,000. Now, when I pay it off in full. So year 10 here, the loan's cleared. Here's the fun part. What's the difference there between the cash value and death benefit? Nothing. Cash value is fully restored, and death benefit for that matter, to exactly what it would have been as if we never touched it in the first place. If you haven't seen our How Policy Loans videos work, we actually go into this in more detail, kind of an overview, and disclose what the dividends are, how they continue to accrue as well. Now, really in this particular example, because I'm using this for real estate, if I take this 100K loan, that's what we're using to pay the loan back. Now, if I don't generate enough cash flow to pay back $25,000 per year from a $100,000 loan or a $100,000 piece of property, because that's not that realistic, well, what we would do is model a longer payback schedule, or perhaps we've got cash flow from another source. That's where we customize the models. These are meant to be a bit more simplified, let's put it that way. Same thing here, 200K loan. There's the reduction compared to the growth scenario. We start to pay it, so $200,000 at 5%, $10,000 in loan interest. So when we are repaying it, we are paying the interest out of pocket each year in this example and throwing money at the principal balance. So the total out of pocket that year is $30,000. 10K of that 30 went towards loan interest. The rest went towards the principal, which is why my principal goes from 200 to 180. And then each year drops by 20 because we're paying whatever the interest expense is plus 20K towards the principal balance. Really, we're throwing 20K per year in a repayment and then paying the interest at the end of each year. But again, main thing I want to focus on here is when it's all said and done. So when this individual is 60 years old, got $650,000 in cash over here, $650,000 in cash, and a $1.6 million death benefit. Everything is fully restored to exactly what it would have been as if he never touched it in the first place. So I do always need to account for the loan interest expense that I have in the policy, or if I'm leveraging elsewhere, the interest expense to the lender, if I'm looking at a collateralized loan or anything like that. But really the advantage where a lot of people get that aha moment or they're attracted to this is really in the sense that no matter what happens, my value continues to appreciate. This $100,000, then $200,000 loan was used to acquire real estate, which is producing a return for the investor, whether it's cash flowing rental properties or if he's selling them down the road, and then he's eventually using those proceeds fully or partially to repay the policy loan. When it is, he's completely restored back to where he would have been as if he never touched the money in the first place. So hope you enjoyed case study number 1. I did. I always enjoy this stuff. Case study number 2 coming up next. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.